Well, now the Reserve Bank is blaming economic stimulus during the COVID period for getting its forecast so woefully wrong. That, of course, doesn't help anybody who took the RBA governor at his word and borrowed on the assumption that rates would not rise until 2024. Warren Hogan is an independent economist and also a consultant for the small business lender Judo Bank and joins me now. Warren, always good to chat to you. You heard Peter King there talking about the lag effect. And this is a real thing. But the truth is that trying to work out whether the Reserve Bank is now behind the curve, playing catch up, or whether it's actually got things just right, that's the thing that only time will tell.
Yeah, and it's really tough. We've had 6 months now since the first rate hike, and the reality is we're not seeing a big negative reaction in the economy. The housing market has responded, but it's a pretty modest response given the frothiness that existed in that market. And more generally, consumer spending still rising in nominal terms, and businesses are strong. We're going to get an update from the NAB on their business confidence survey. Last month in September, it was at near record highs in terms of conditions. So,
this is what they've done, and that seems to be quite a lot until you compare it with, say, the United States. Now, inflation is higher in the States, but they've gone from basically 0.1% to 4%. We're at 2.85%. And it just makes you wonder, what do you actually have to do to change consumer behaviour? Because that so far has not worked. If we look at the US target funds rate here, you can see what they've done, which is more dramatic than what Australia's done. Now, the Reserve Bank's got a little bit of time to think about this. December, well, it meets. January, it doesn't.
It's got one meeting in the next 3 months. When it was doing 50s and meeting every month, it was essentially keeping pace with the Fed, who was doing 75 points every 6 weeks. But the Fed's still doing 75 points. The RBA is now to 25s. And then, of course, in January is the month that the RBA doesn't meet. So the problem, I think, that's starting to become clear is that the Fed last week told us they're not ready for pivoting, or if they are, they've still got a long way to go on rates. And this year you can see quite clearly is if the Fed keeps going as they have been signalling they want to, and that gets that Fed funds rate up to 5 by late January, and we have a 25 in December, what we've seen the last few months, we're going to have a negative almost 2% interest rate difference.
Well, it also says that the Aussie dollar is going to be sitting about 57 US cents if that's the case, if not lower.
It certainly leaves the Aussie dollar vulnerable to a shift in sentiment, whether it's commodity related or domestic economy related. I just don't think that is a healthy state of affairs for us. I don't think lagging the global interest rate so much is healthy. And I think also the economy is not slowing down rapidly.
Well, OK, let's go and have a look, because the argument is that these other central banks do not meet on a monthly basis, and Australia does. And therefore, if they miss a month and the RBA goes for a 0.25% for 2 months, well, they're basically playing catch up, as you say. But you can see here that really with the UK going at 0.75%, the US going at 0.75%, New Zealand continuing to go at 3.5%, the gap is building, and it's not just against the US.
Yeah, no, we're lagging the global cycle. The RBA feels they have some wiggle room, but I think with the month off in January, the fact that they've downshifted to 25s, I think they have to actually front load that January move. They can't leave January with.
OK, but haven't they sent a big signal to the markets? Haven't they sent it? And you can see it, you can feel it, that really consumer confidence is not falling off a cliff. Nothing's really, consumption's not really changing. I mean, people are spending on different things maybe, but they're still consuming. So this is where I'm wondering. And you look in the building end area, that's where you see some of this.
Yeah, no, the balance of risk to doing 25 in December is shifting to them getting well behind the game by the time they get back from holidays in February.
Yes.
And I think that really argues the case to go 50, and they can explain it quite simply, and they've got a number of speeches in the next few weeks ahead of the meeting, as that they can do 2 25s in one go because they don't meet in January.
But you've sent some stuff. You've also sent us a chart about, about building starts as well. And that says something about this as well.
Well, the housing correction is meant to be a very important part of the initial response to higher rates. And this was last week's latest update on building approvals. And you can see two things. One, housing approvals are stabilising after the big falls of the last year. They're stabilising at what was pre-COVID extremely high levels.
Yes.
And of course, this apartment market building correction, which has been going on for 5 years, looks like it may be swinging up again. It's early days, but residential construction activity is going to contribute to growth in the next year, not detract from it.
There you go. Warren Hogan, always good to have in the program. Many thanks for your time today.